A weak bond sale auction in Germany has sparked fears that the debt crisis is beginning to threaten Europe's strongest economy. How worried should we be? And what's the fallout for the entire Eurozone, already reeling from a worsening economic and financial situation? This is Inside Story. Hi there, I'm James Bays. Is the Eurozone crisis now getting even worse? For 2 years, the number of troubled countries has grown. Economic crisis and political turmoil spread to Greece, Italy, Spain, Portugal and Ireland. All the while, one country, above all the other members of the 17-nation Eurozone, has been seen as totally safe, solid and stable. Now, though, mighty Germany, Europe's economic powerhouse, has had a rude awakening as a sale of their government bonds has flopped. Investors didn't buy all of the $8 billion on offer in German bonds, usually considered a safe bet for investors. But the failure sent stocks diving across the globe and the euro slid to a 7-week low against the dollar. And as the leaders at the helm of the Eurozone's 3 largest economies met in Strasbourg on Thursday, the question people are asking, if Germany can't sell their prized assets, what hope does the rest of Europe have? German Chancellor Angela Merkel was quick to defend the bond failure.
I think it is inappropriate that the Commission proposes Eurobonds as a solution. Just by proposing it, the impression is given that sharing debts will solve the problems we have with the structure of the European Monetary Union. And this will not be the case.
We are, with today's discussion, in complex financial territory. But fear not, we have a panel of guests who'll try and make sense of it all for you and for me. And joining us from London, we have Angus Campbell, Head of Sales for London Capital Group. Richard Milne is the Capital Markets Editor at the Financial Times, and Tim Ollenberg, a Senior Economist for the Centre for Economics and Business Research in London. Welcome to you all. Let me start with you, Tim. We hear about the bond markets, we hear about this bond auction. Tell us exactly what that was and why it is so worrying.
So what happened is that the German state, like all countries, borrows money from the market on a regular basis, and the latest auction was not fully subscribed, and this is something of a unusual event. Usually investors are quite keen to buy German debt and will pay what it takes to get an allocation of that debt, and the last one, a significant chunk, was not sold. Now that may have had some technical reasons of that particular debt being sold, but it seems to indicate that confidence is waning even in the core countries of the Eurozone now.
Richard Milne, you're from the Financial Times. I was on your Financial Times website earlier on. One article said Germany's the only first-class passenger on the Titanic. Is that how you see it? Is this pretty disastrous?
I don't know that I'd go that far. That's pretty inflammatory language, but it's certainly clear you've had this spiral of events. It's moved from Greece. We a few weeks ago started talking about Italy, and then it moved on to France. Of course, Germany is at the top of the house of cards, so to speak. So I think this is really important, and you see it also that US bonds are becoming much more attractive to investors. I mean, if Germany gets infected, it is big news. I suppose the silver lining for some investors is that maybe if Germany starts to get really impacted, then that'll force it to move, because at the moment Germany's holding dragging its feet on a lot of subjects in terms of trying to solve this crisis.
Angus Campbell, what's your view on this? Was this just a glitch, or is this a big problem?
Well, we will have to wait and see until next week, in the run-up to the end of the year. There are several very important bond auctions into the end of this year. In fact, funny enough, you mentioned Germany being a first-class passenger on the Titanic. I would probably classify them more as maybe business class than first class. This is a clear indication that investors' appetite for even Europe's paymaster, the biggest economy in Europe, is waning. global investors are unsure, they're uncertain, and feel that maybe even Germany, which is itself suffering from growth which is slowing, could well be dragged into this crisis too. So as I say, in the run-up towards the end of the year, next week in particular, there are some major bond auctions that we'll have to monitor very closely to see if this subscription that we saw this week is going to be low again next week.
Tim, is this a vote of no confidence in Germany or a vote of no confidence in the entire Eurozone?
I think it was one event, and auctions like that are not always fully subscribed, so this thing happens once in a while. But there's a clear trend visible here that, as we heard before, it started out with the small economies, went to Italy and Spain, then France, French yields started going up. So yields, that means that basically the interest rate that is paid on sovereign debt. But the risk premium is what's going up here. So basically, people's expectation of what the basic interest rate is hasn't changed, but what's changed is their perception that their money might not be repaid. So that's been happening for France already, and now we've seen that in Germany as well. It may be that this is just temporary, but there's a clear trend, and I think this is one of the first signs of that trend becoming more visible.
Richard Mill, I'm sure you've been working the phones. What are people saying to you about this? How shocked are people by this? Because Germany has always been seen as the stable, secure nation in Europe.
There are definitely two schools of thought. If I take the sort of most pessimistic one, which appeals to most to the journalist in me, I suppose, serious people are now starting to question whether we might see a Eurozone breakup, and in which case Germany would probably suffer. Even if the Deutschmark came back, it would become a very strong currency. There's a feeling that probably whatever the solution is, Germany will somehow have to pay. But I think there is a feeling that this is one event. German bond auctions have failed in the past. You shouldn't get too far ahead of yourself in terms of discussing this, but I think the very fact that people are sort of openly discussing the possibility of the euro breaking up now is a worrying sign.
If we're seeing cracks with Germany, Angus, does that leave us any safe havens for investors in Europe?
Well, it's a good question, really. I mean, you certainly wouldn't want to go anywhere near any of the peripheral bonds or anything like that. As your two other guests have said, this is one bond auction that we've seen. It certainly hasn't been well subscribed, so there are alarm bells ringing. But as I say, we need to monitor very closely the other auctions into the end of the year, and if this continues to be the case, and we can't get away debt of Italy, Spain, Belgium, France next week, then we start to worry. And Germany is not necessarily the safe haven that people had previously thought, because let's face it, they've got a very big mountain of debt themselves, and if their growth does start to go down, which is expected into next year, we've had several downgrades to their growth forecasts, then things will get even tougher. Are there any other safe havens in Europe? Possibly not. Obviously the UK bonds, the gilts there are looking relatively safe-ish. We haven't seen yields spike up so much, but again, we have our own structural deficit problems as well.
Tim Ollenberg, if I can ask you to take a look at the map right now and where the other problem areas are. There seem to be so many, and among the latest news was a downgrading by the ratings agencies Moody's of Portugal to junk status. Just explain to our viewers what that means.
The rating agencies basically give people that borrow money, also states and companies, a grade, and that grade indicates how risky they think credit is, so how likely it is that it will not be repaid. And there's a line, there's a certain rating below which something is called a bond, a junk bond, or junk status in general, and that means that it's at high risk of default.
Richard Milne,
So,
we know about those countries, the troubled countries we've talked so much about. If you look beyond Portugal and Spain and Greece and Ireland and all the ones we've focused on, are there other places that you're worried about? And where in particular?
Well, I think if you're looking at the Eurozone, you can be worried about almost every country. I think a central country would, the two central big countries would be France and Italy before you get to Germany. I mean, Italy, we know it's in a lot of trouble. It's got a new government. We have to wait to see how that develops. In the markets, they're already seen very sceptically, but France is going back to the credit ratings, they're AAA rated, that's the top rating, you can't get any more, that's suggesting they should also be in the first class of the Titanic. But a lot of investors think they're not. Their bonds had been trading considerably away from where Germany's were, which was suggesting that investors viewed them as far less attractive, far less credible. And this is because France hadn't really, in the past decade, hadn't done the necessary reforms. So I think that the French are crucial, and they're also crucial because they underpin the Eurozone bailout fund, which is known by this acronym EFSF, and its ability to borrow in the markets is largely based on Germany and France continuing to have these top credit ratings. So if that is threatened, and the credit rating agencies have started to talk about that possibly, that's something I would watch very carefully.
Angus, France's much smaller neighbour, Belgium. Tell us about the situation there, because I believe the interest rate on their bonds has now risen above 5%. Should we be worried about Belgium now?
Well, the main concern about Belgium is that it has this sort of multinational bank called Dexia, which just recently has required yet another bailout. And I think if you just go back a few years and remember where this whole problem has stemmed from, and initially that was the credit crunch and banking crisis, which has now morphed into the sovereign debt crisis, where governments have been having to bail out banks that have substantial exposures to assets that some people even today don't even know just how far those exposures go. So if you're a small country like Belgium and you have to prop up a very, very large bank that has exposures across the globe and is exposure to debt of these troubled nations, then you have to worry, because it possibly could get to the stage whereby Belgium simply can't afford to keep their banking system going, which is why France has had to share some of that burden. So yes, Belgium is a particular worry, purely because it's one of the smaller nations, and it just goes to show that it is by no means immune to the problems.
Well, those problems are pretty grim, the picture that you have all painted. What are the European politicians going to do about them? Well, the President of the European Commission, José Manuel Barroso, has been giving some proposals earlier on this week. Let's listen to what he had to say.
Stability bonds will not solve our immediate problems and cannot replace the reforms that are needed in countries currently under pressure. But it is also important to show to public opinion, to international investors, that we are serious about stronger governance in the euro area, both in discipline and in convergence. And stability bonds are exactly an example of that. An example of reinforced governance, of a strong will to live together in the euro area, and a good example of discipline and convergence.
Tim, you have seen those proposals from the European Commission. Explain to us exactly what they're proposing and how it would work.
So there are two components here. One component is to say that instead of every country issuing its own debt, Europe should issue debts for or the Eurozone instead should issue a debt for all the member countries. And that's the one side. So the other side is that to make that system work, where basically everybody steps in for everybody else, for all the other countries, so that the taxpayers of one country are in effect helping those of another country borrow. That would require certain safeguards, some processes to make sure that everybody behaves responsibly. The system that we had before, the Stability and Growth Pact, obviously failed Europe, and that's where the current troubles come from. So the Commission is proposing issue those bonds together, but put new measures in place that make sure that in future countries run sustainable deficits.
Richard, all this talk about, we've been talking about bonds, but now talk about euro bonds. That's something Germany has been very strongly against.
Absolutely. The Germans don't like the idea that the other countries would get off the hook, and also that Germany would end up paying for it. There seems to be some softening. Germany has talked about fiscal union, which it's not clear exactly what that phrase means, but something similar to Eurobonds probably in the end, that they see that maybe as the end game, just not right now. I suppose if I were judging it, I'd say it seems to me, if you're going to have a currency union, everybody says you do need fiscal union, you probably also need political union. That seems to make sense. I just worry that we've seen that the euro itself, it doesn't have the necessary institutions and the necessary rules to keep it stable, and I just wonder if you put another structure, i.e. euro bonds, on top of what's already something quite wobbly, I don't know whether it makes it more secure.
Angus, what we were talking about earlier, the failure of the German bond auction, do you think that affects the moral authority and political clout of Germany as they talk about these things in Brussels?
Well, as I say, I think, and as all your guests agree, that the bond auction this week, is not the be-all or end-all. We'll have to see how the auctions go until the end of the year. But certainly, Germany is the European Union paymaster, and their credibility is crucial. But what they have to appreciate is that really, if they rely very, very heavily on the periphery of Europe and other European nations. It's in their interests for Europe to be stable. And they have to appreciate that really, if they're going to be the main driver behind further political integration and fiscal integration, probably the first base that you start at would be a euro bond. And so we have to see some sort of movement from them in order to at least provide a little bit more confidence for the market.
Can I ask you, Tim, the bond auction failure, I'm coming back to it again, and I do accept the point, it's not the be-all and end-all, but do you think that could be an indication that investors believe down the line Germany is going to have to pay up?
Yeah, I think this is the underlying issue. The markets have suddenly realized that actually the Eurozone is only comprised of so many countries, and now we already have Spain and Italy, very major economies with large problems. France saw its risk perception rise substantially of the big countries that leaves Germany, and Germany just cannot shoulder the entire debt burden of the of the Eurozone. So it's only natural that if markets are worried about everybody else, now if Germany were to try to lift that debt burden, it couldn't. So it's just natural that sort of that risk perception moves closer to that of the other countries, such as France.
Richard, if I could ask you, how bad could this get? What's your worst case scenario? I mean, could we see another credit crunch, banks not lending to people? Could we see banks again failing across Europe?
I think we're already starting to see the last part. If that's the worst case scenario, it's largely here. I'm just doing some reporting for a piece at the moment, speaking to lots of large chief executives of large companies in Germany, Spain and Italy. This morning they all think the credit crunch is here already. They all think that probably a recession is here already, not just in their countries but European-wide. I think the worst case scenario is you have some kind of breakup now of the euro. Now that could be, some people could view that positively if it was just Greece that left the euro. I think the the danger. And I mean, there are some overly excited people in markets. You have to appreciate, but that start to think maybe Germany could leave the euro. Is it in its interest to pick up the bill? I don't think that will happen, but I think from an extremely negligible chance a couple of years ago that you now can't discount the fact that there could be a breakup, and you're seeing increasingly analysts' notes, banks thinking about what a breakup would mean.
Angus, what's your view on this? How bad could it get? Paint a picture for us.
Well, I think summed up pretty well. To be honest, the worst case scenario obviously is a breakup of the Eurozone. Greece falls out of the Eurozone, there's no firewall in place, and that has huge ramifications. The next dominoes fall, Portugal, Ireland, and then possibly even the bigger ones of Italy and Spain. That's going to cause serious problems for growth. You'll see banks go under, taxpayers probably having to foot the bill again, and there will be a prolonged period of recession, and a very, very deep one as well. That's the worst case scenario. What we mustn't underestimate, as we've seen in the last couple of years, is the political will from leaders in the Eurozone. Certainly would illustrate that they're doing their best to try and prevent any breakup. Germany doesn't want to go it alone and suddenly go back to the Deutschmark. So if we can get this firepower, if we can get some sort of turn the ECB into the lender of last resort, which would probably be the silver bullet, then we can restore some confidence. We'll see the banking sector recover, we'll see lending go back to businesses, and we'll see some growth. So there's two sort of extreme cases there. At the moment, it would seem that people are more arguing towards the worst case scenario because the financial markets are so gloomy at the moment. But it is a question of take your choice. How optimistic do you feel?
Tim, do you think recession can now be avoided? Because while all this is going on in Europe, what you've got on the other side of the Atlantic in America, the failure of the super committee to sort out America's financial problems.
Yes, it looks that this is not just a Eurozone issue. Public debt has been on the increase and has risen to very high levels in other parts. And the US economy is still the dominant economy in the world. I'm seeing, sort of related problems. It looks at least for Europe, recession is the likely outcome now. It doesn't seem that the politicians have been able to come up with a solution to this confidence crisis, actually, and it doesn't look like they will anytime soon. There will be a summit soon in early December, but again, it does seem unlikely that the big steps will be taken. As was said before, perhaps the ECB could temporarily solve the solution, but markets have always decided that fundamentally they don't like the solutions at the end of the day.
Richard, do you think there'll be a global recession? Because I'm even reading about these wildcat strikes in China because of a lack of demand from Europe.
I mean, I think that's the question that all investors are pondering at the moment. The data in recent weeks and months had pointed towards the US and China actually doing quite well and maybe being more immune from the European troubles. I mean, I think if we go anywhere near any of the worst case scenarios, there will be a global recession. I think more fundamentally, you probably have to look at the Chinese economy, and I think everybody's probably got a viewpoint on the Chinese economy, but nobody really knows what's happening there. There have been some warning signs. The FT reported that property sales had fallen really rather dramatically, and I think if you look at the US as well, I mean in Europe at least, the Eurozone's got the excuse of having 17 countries and God knows how many political parties. As Chief Executive said to me this morning, the US has only got 2 parties and 1 Congress. If they can't agree, then that they can't really set an example to the rest of us.
Well, thank you very much, Richard. Thanks to all our guests, Angus Campbell, Richard Milne, Tim Ollenberg, and thanks to you, our viewers. You may not have been an expert on the euro crisis before, but perhaps you almost are now. What did you think of the discussion? What should we focus on next? Send us your emails, insidestory@aljazeera.net. I'll see you back here 24 hours from now. Bye-bye.